Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Matt Kaufman. He is the head of ETFs at Calamos Investments. And we are talking about their latest innovation, which is a suite of protected Bitcoin ETFs. We've got 100% downside, which is CBOJ, 10% at risk, which is CBTJ, and 20% at risk, CBTX. Matt and I talked for about 20 minutes on how these portfolios are constructed, how they work, and who are they best utilized for. I think their timing with these products is excellent. So without further ado, please welcome Mr. Matt Kaufman. And we are live from the Exchange ETF conference. I'm here with Matt Kaufman from Calamos. Matt, welcome back to the show.
Thanks, Brad. Thanks for having me in Las Vegas, not Miami this year.
Yeah, I mean, it's still nice here, but for me as an East Coaster, I think I'd rather take the short flight than the long flight, but it's great.
You'll take the humidity and the short flight versus the dry, temperate climate.
Plus all the money I'll probably lose at the blackjack table.
Fair enough.
So why don't you briefly just refresh everybody on who you are, what you do, and a little bit about Calamos as a whole.
Sure. So Matt Kaufman, I'm the head of ETFs at Calamos Investments. For those not familiar with Calamos is about a 50-year-old risk manager, largely built on a foundation of convertible bonds. So if you're not familiar, for those listening, with a convertible bond, it combines a call option, upside option of a company, and it ties it to its fixed income counterpart or its corporate bond. So what you end up with is the upside of a stock in good markets, and then you've got a bond floor. If that stock stops performing, you've got a built-in bond floor. So Calamos was built in the 70s, 1977, just a few years after the Chicago Board Options Exchange was founded. And it was, again, largely on convertible bonds. We're the largest converts manager in the United States, and one of the largest alts managers, largely on the back of the Market Neutral Income Fund, which is one of the largest alts mutual funds in the country. So I said the mutual fund word on an ETF podcast here. But as we moved into ETFs, Calamos is now in the ETF space. We've been at it for about 2 years now, and we have a lot of risk management products, as you might expect. We built the world's first 1-year, 100% principal protected ETFs on the S&P 500, the Russell 2000, the NASDAQ 100. So I think you and I spoke about that about a year ago. We had a lot of great reception on those. We've launched a few other ETFs into the market since then. We have a converts ETF that's performing very well. We've launched what I would call a synthetic convertible strategy, where we buy call options on stocks in the NASDAQ 100. And then we pick our own bonds. We've got an actively managed bond portfolio. That is one of, if not my favorite ETF in our lineup. We've outperformed the Qs since inception last year with less risk. So it's performing very well, delivering exactly as we expected. And then the newest offering that we just brought to market was protected Bitcoin. So you can now get the exposure to Bitcoin with built-in protection. The way that we talk about that is you can now get that with a safety net. You have 0% downside risk. You can choose to put 10% at risk or 20% at risk. And then your upside opportunity just varies and goes up based off of how much you're willing to put at risk. As we're in Vegas here talking about a casino, there's, risk reward trade-offs, with how much you put at risk and how much upside you can obtain. Not that that's gambling by any means, but that's an investment.
Yeah, I mean, and that's what we're here to talk about today is these new structured Bitcoin products. I joked with you when you got here. I said I had a feeling these were coming. So at kind of a high level, can you explain what these structured alt protection ETFs are and how they work?
Yeah, last time we spoke, we were talking about doing these on very broad liquid underlyings like the S&P, NASDAQ 100, Russell 2000. So believe it or not, Bitcoin is now one of those assets. Bitcoin is the seventh largest asset in the world. It's almost $2 trillion. If you view it by commodity standards, it just passed silver. Silver is about 1.7, 1.8. Bitcoin's about 2 trillion. If you put gold is number one, and gold is about $18 trillion asset. But all that to say is we now check the boxes for the ability to, what I would say, safely deliver a hedged version of Bitcoin. It's a $100 billion ETF market. There's liquid options on those ETPs now. A short story on those is the ETP options like IBIT, FBTC, those all have position limits. And so you really can't build an ETF using those options today. But what we ended up doing is we worked with SIBO, Chicago Board Options Exchange, and they built an index that was primarily to be used by these ETFs, by the Bitcoin ETFs that we built. And that index tracks the underlying of the 11 spot Bitcoin ETPs in the market. So what you end up with is about 100% correlation to the price of Bitcoin, and we can deliver options on that index. And so now we've built a framework so that you can now access Bitcoin in a risk managed way. And there's a whole host of implications in why you would do that.
Yeah. And so, it's obvious, Bitcoin is known for its volatility. So these structured protection ETFs really are for that client who probably wants exposure to the asset class, but is scared of, that crypto winter that seems to come every so often.
Yeah, the crypto winters, seem to come every fourth year, and I think we're in the third year of 4. And so, if you're a student of history or you think that it repeats itself, then that could be a reason to enter into a protected version of Bitcoin. I think we're down 20% since we launched CBOJ, which was our 100% protected series, and the ETF worked exactly as we expected. It protected investors from nearly all of that loss. It will be all of that loss protection if you hold till the end of the 1-year outcome period. I think CBOJ is down about 1% right now, while Bitcoin's down about 20%. But as far as application points go, you think of 0% downside, 10% downside, or 20% downside. And then the upside caps that we're seeing, right now for a 20% floor, so 20% at risk, may give you a 50 to 55% upside cap rate. So really significant upside relative to Bitcoin with a 20% floor. The 10 floor, maybe about a 30 cap. And then the 0 floor, it's about a 12% upside right now.
And so, you mentioned a 3. So we have CBXJ, CBTJ, and CBOJ. So CBOJ is the 100% downside protection. Can we go a little bit deeper? So if we're looking at the underlying holdings, how is this thing constructed in order to deliver this protection? I know it uses options, but can you just kind of go into that a little bit?
Yeah, so if we can just recreate that 100% protection product. So pretend like I give you $100 or we spend 100% of the portfolio value. There's no leverage or anything in the products, but we'll spend about 96% goes into U.S. Treasuries, and those are 0 coupon bonds. So they're not paying you any interest or any income, but the interest rate, so let's say interest rate's about 4% today, the price that you pay is discounted by the amount that you'll receive over the life of those bonds. So that's why it's 96% and not 100%. So we spend about $96 on those 0 coupon bonds, and that gives us about $4 or 4% to play with. And I'm going to buy a call spread on Bitcoin that's worth $4. So the way that we would do that is we buy an at-the-money call on that Bitcoin index, again, as we were talking about. That's an expensive call option. Bitcoin's volatile. That's going to cost you about 25%. You've already spent 96% of your money, so you're going to blow your budget. So the way you bring that back in line is to sell out an out-of-the-money call on that Bitcoin index to collect 21%. And the difference is 4%, that 4% that you're collecting from your treasury bonds. So that whole package works together to deliver a 100% protected experience over a 1-year outcome period. And then for the 90% protection of the 10 floor, instead of 96% in bonds, we'll hold about 86%, and then 76% for the 80.
That makes a ton of sense to me. So Let's talk about how markets can impact, these ETFs. The structure doesn't change. It's buy and hold. You're flipping it at the end of the year. But for example, if Bitcoin experiences, a really sharp decline, let's start there. Do you have any sort of arbitrage in the product if you maybe buy it later into the 1 year? And I know we talked about this with the index or the equity version, but I think we should refresh everybody's memory. It is point to point. So it can react somewhat differently in the middle of the outcome period. So let's start with sharp decline. Bitcoin's down 20%. What can investors expect holding these products?
Yeah, I think understanding that starts with an understanding of what a floor actually is. So there's floors, and you might be familiar with a buffer. So a buffer is going to protect you from the first set of losses. So if you have a 10% buffer, you're going to be protected from 0 to 10, and then you're exposed from -10 to -100. So you have 90% at risk. A floor is the inverse. A floor is going to expose you to the first 10% of loss, and then you're protected from -10 to -100. So that's why I say this allows you to choose how much to put at risk. I know going ahead of time, going into Bitcoin, how much I'm going to put at risk. The reason that you want to do a floor and not a buffer is largely because of the history of returns of Bitcoin. It's extremely volatile. If you look at the returns of the S&P, it looks like a traditional bell. You've got most of your returns around that 0 to 20% mark. Some, 40% or more, a little bit of fat left tail. You go to Bitcoin, it's exactly the opposite. It looks like a smile, not a bell. It's all 40% or more up, 40% or more down. So you want to know that you've got significant protection. So now that we kind of set that framework, we can answer the question. So if Bitcoin falls significantly, you know that you have a floor in place. And these are point-to-point products. If you buy in at the beginning, you know what your outcome is, but you can buy in anytime the market's open. You can go to our website, calamos.com. You can see where each of these are trading. You can see what the upside is, what the protection level is, and how many days are left in that outcome period. But what I like about the floors particularly is as Bitcoin's going down, your outcome for new investors actually improves. So the 20 floor CBTJ, we had a 52% cap rate, 20% floor on day one. Today, that's actually much better. Today, if you bought CBTJ, I haven't looked since I got off the plane, but I think you get a cap of about 60 to 62%, and you've got about a 15% floor. So it's actually a better deal for you to buy today than it might have been on day one.
Yeah, it's funny. I've my brother has started a little project of looking at your ETFs like every day and whether or not there's an arbitrage opportunity, because there can be a lot of opportunity mid point to point in some of these, and it's obviously worth like taking note of. So these structured products are fairly new to the market, right? At least in the ETF market. For those people, the advisors listening to the show, what are the risks here in terms of maybe liquidity or potential mispricing? I mean, can you just kind of talk about that? Because these are fairly new in the ETF space.
Yeah, this was an exercise that we made sure we had down before we brought the products out. So again, like I said, you don't want to build defined outcomes or structured outcomes on illiquid assets. And so you're not going to see an Ethereum or a Solana protection product from Calamos anytime soon, because those assets simply aren't mature enough to be able to do that. When you build and innovate in the financial services space, you've got to do it with security. If you're building a piece of technology, a lot of times you can build, the first version, you get it out to the market, it might break a couple, pieces of the software might not work right, and then you iterate and you update. I think around the 350th iPhone update since they came out with those,
and it keeps eating up my battery every time I update it.
Yeah, exactly. Like when you're dealing with financial services products, you simply can't do that, and a lot of times because you're dealing with people's life savings. And so we build things. I'd say with the shades drawn, we build things at Calamos and spend a very long time making sure that they work before they bring them to market. So you look at an asset like Bitcoin, a $2 trillion asset with a liquid ETF market, and now there's options on the index that we can trade. And so we've built a big desk of market makers, went through the exercise of pricing all of those options for several months before everyone was comfortable with the idea of building this and bringing it and had it just running in the background as a test for several months until we were finally in a place where like, okay, this is ready for the market. And we've been out for a month. It's worked exactly as we designed it. Even in a down market, like we had the test, it worked. It's working great. Liquidity is there, and so I think people can come in confidently.
Well, that's almost like a benefit for you that you get to showcase it, right out of the gate, and you don't have to wait for something to happen to really showcase the value here. There's a lot of other benefits to these types of products. Mainly, you're going to get better tax efficiency at the end of this point to point. You're not going to have to, because it's wrapped in an ETF, you're not going to have to go out tomorrow, like as an individual investor putting these together. So just from a fee standpoint, what does the fee structure look like on these? I know it's going to be more expensive, but it should be more expensive. So can you just talk about what somebody could expect on a fee schedule for these three?
Yeah, we charge 69 basis points. That's the unitary fee for the ETFs. That's about as simple of an answer as I've got.
So kind of the last few things here. Do you start to see or foresee more structured products in different areas of the financial market? Like, is this going to go all the way down to sector specific exposure? I think of, the sector spider ETFs, and are you even going to go deeper into finding more places to make this work?
Yeah, there's, thousands of ETFs in the market. I remember 15 years ago when people would say, is the market saturated? And there were hundreds of ETFs in the market, and we just keep finding new areas of opportunity. And I always say it's a great time to be an investor, especially with ETFs in the market, because you can, now get, we call spot exposure. You can get the S&P 500, and there's so many different derivative, to use a pun there, derivative options that you can use to get exposure to the S&P 500. Now you can get income, you can get buffers, you can get a 5%, 9%, 10%, 15, 20, 30. Like there's every different opportunity for you to access the S&P in a way that works for you. And so you can see how the universe of options and ETFs expands. The structured note marketplace, has been around for 3 or 4 decades. And that really started to be disrupted in the ETF space around 2017. I was building some intellectual property that was doing buffers on the S&P 500. That was the best-selling trade at the time, or the best-selling note at that time, because interest rates were so low. You couldn't afford to do 100% protection, but you could do something less. You could give someone a buffer on the market. Well, interest rates are in a much different place now. You can afford 100% protection. And so now the capital protected note space is being disrupted and being captured. So there's the ETF wrapper has been a wrapper for innovation for the last 35 years, and I don't see that changing.
Yeah, no, neither do I. Only see it getting bigger. Do you foresee anything else coming? You probably are following the space, specifically kind of the crypto space, a little bit closer now. Any developments that might be coming to enhance product offering? Do you have any kind of foresight into what might else be coming so that we can continue to innovate specifically in the crypto ETF space?
Yeah, as far as crypto ETFs go, we watch the options markets very closely. And so I think the lifting of position limits on IBIT and other spot Bitcoin ETPs may, cause more people to enter the market into those types of solutions. We don't have to build things that way, but I do think there's going to be a lot more innovation and product development when it comes to giving people exposure. What makes me a little nervous is when you start to see less liquid underlyings. And so I think it's important for investors to do their due diligence and know exactly what they're owning. Now, not only are you owning a volatile asset, but you're owning it in a way that you may not understand, or in a way that might not give you liquid exposure to that asset. So that's something I think Calamos can add an edge in, and where we can really sit squarely in, is providing risk management exposure in a way that people can trust. We've been around for 50 years. We're not going anywhere, and we're not going to build a methodology and blow the place up over a Bitcoin trade,
Yeah. So in your mind, who do you think is kind of the ideal investor for this type of product? I could see it being a couple of different people. As somebody who wants to dip their toe in the crypto space, but doesn't want to get, blown to pieces if things get ugly. I could see some people who maybe are running active Bitcoin strategies, using this as maybe their risk off tilt. So they're still going to get upside exposure, but maybe they're risk off and they get long one of your downside protection. So in your mind, who do you think is is really looking and going to be buying this product?
We could do a whole podcast on that alone. It's a great question. How we're seeing advisors use this, and even retail investors and some institutions, which is probably why I said we could go a long time. We see a lot of advisors building models. They're building crypto models right now. The early adopters are, and they're using our ETFs as a core for that. They've got some Bitcoin exposure. They've got Ethereum. But they're using the 20 floor as their core. They don't want to blow up the client. They want to know what their downside risk is. And, to them, 60% upside for a sleeve is quite enough upside. That's good for them. It's a bit of a mind bender too, but if you can get there, when you think of a risk-free rate product or capturing risk-free upside, Bitcoin is actually your best power source, because Bitcoin, has a 12% cap rate. And the odds of it achieving a 12% cap are high. Bitcoin goes up significantly. It can go up 12% in a day. It can go down 12% in a day too. But if you're capturing that 12% cap 3 out of 4 years, you're in a remarkably better spot than if you had captured your 4% CD rate in after tax. So the summary here is we've seen some of the larger asset managers do studies, and they'll find that you should sell some of your Mag 7 exposure, move 1% to 2% into Bitcoin. I think that's the most like for like comparison they could come up with was, high flying tech stocks. But I don't know that we should do it that way. I don't know many advisors that just have those 7 stocks laying around that they're going to then turn in and get their Bitcoin exposure. But here, we've actually, right sized the volatility of Bitcoin. And so now you can make it a much more traditional portfolio experience. If you're a traditional financial advisor, maybe you're using CBTJ for your equities, you're using CBOJ for your bonds or for your safer money. And that opportunity didn't exist before. And so I think that's where we're going to see a lot of demand. And now we've given advisors a familiar framework for accessing Bitcoin.
Well, Matt, Bitcoin only goes down 12% in a day when I buy it. So
yeah, exactly. Me too.
But hey, I appreciate you jumping off the airplane, coming right over here and hang out with me for about 25 minutes. Before I let you go, where can people go learn more about Calamos and this new Bitcoin ETF suite?
Yeah, go to calamos.com. You can go to our ETFs and see all of the ETFs we have there. To your brother's point, he's probably using our structured outcome tool. That shows you every product we have and where they sit relative to their outcome period. So we see a lot of people using that tool also.
Well, again, Matt, thanks so much for being with me.
Take care.